Since your job is to make sure that all the rules are followed, here's even more rules for you to know. You will have questions on reviewing and accepting account information from your customers. Just a basic review of mutual fund account characteristics. Many mutual funds will have minimum amounts that you must invest in order to get started with that fund. Some funds will waive the minimum investment amounts when the clients sign up for regular investments through electronic funds transfers. Once a mutual fund account is opened, investors oftentimes will choose to automatically reinvest their income distributions. So the dividend that the mutual fund pays and the capital gains paid by the mutual fund, the investor could choose to take those in cash, but more often than not, they will just say to the fund, you just keep those. Use those income distributions to buy me more shares. When the investor does that, do they avoid having to pay income taxes on the dividend and the capital gain distribution? No way, of course not. The IRS will tax the income distributions from a mutual fund, whether or not they are taken in cash or used to automatically reinvest in the fund. Most funds, when you automatically reinvest, will allow you to do so without an additional sales charge. So that is one of the benefits. When the client takes the income distribution in cash, that's taxable. When they leave it in the fund, that's also taxable. So it's important to remember, income distributions automatically reinvested into a mutual fund have the effect of increasing your investor's cost basis. So always keep track of that. Automatically reinvested dividends and capital gains increase the investor's cost basis. So of course we're talking about in a taxable account, not in a qualified plan like a 401k, a simple IRA. Qualified plans have tax-deferred earnings. There's no taxable event when you automatically reinvest when you are in a qualified plan. Some mutual funds will allow the client to, when they're ready, begin an automatic withdrawal plan. It's important to remember that a client should never be buying mutual fund shares and engaging in a withdrawal plan. You'll always be, if there's a load, buying at the ask and redeeming at the bid, paying the sales charge. So you'll always have a net loss position. Some funds will allow a client, once their account gets to a certain balance, if the client would like to, begin a withdrawal plan. So the opportunity to withdraw money from a mutual fund systematically over a period of time, usually monthly, although it could be quarterly as well. Payments are made first from dividends and then from capital gains. If these are not adequate, the fund must redeem the investor's shares in order to make the specified payment until the principal in the account is exhausted. There are 4 different ways that withdrawal plans may be set up. A fixed dollar plan, where the investor receives the same amount of money at regular intervals until the funds are exhausted. A fixed percentage plan, where the investor liquidates a fixed percentage of their account on a regular basis, generally monthly. A fixed share plan, the investor advises the fund to redeem a set number of shares every month. The value of the shares varies every month, so the payment will be different every month until all of the shares are liquidated. Or a fixed time plan, where the investor tells the fund that they would like to liquidate their balance over a set period of time. It's important to remember that withdrawal plans are not annuities. You can outlive the payments of a withdrawal plan. The client may exhaust their funds. So the SEC is really cautious that the client never thinks that this is like an annuity product. Forms of ownership of investment company shares. An individual account is opened by and for just one person. It is the simplest and most common type of account. In an individual account, the only person who may place orders for that account is that individual. The test will try to trick you. Can the spouse place an order? Never, not unless the spouse has third-party trading authority. Or if it's a joint account. But unless it says it's a joint account, don't assume that it is. What kind of joint accounts are there? The test wants you to be comfortable with the two types of joint accounts. So joint accounts, we have tenants in common, and then we have joint tenants with right of survivorship. Joint tenants with right of survivorship is what you commonly will see a husband and wife title their account as. In a joint account, any joint owner may place orders for the account. New account information must be obtained from each account owner, and ownership must be equal. Must be equal. In joint tenants with right of survivorship. If one owner dies, the ownership of the account automatically passes on to the surviving spouse without having to go through the probate process. In a joint tenants with right of survivorship account, checks may only be drawn payable to both account holders jointly, which makes sense. The husband can't liquidate the account. The check has to be made payable to both parties. Mail, however, may be directed to either tenant. Tenants in common is a type of account where you have two or more people and the ownership need not be equal. So tenants in common need not be equal. When one of the tenants in a tenants in common account dies, their interest passes on to their estate, where it can pass by will to any named person, commonly set up for business partners. In a tenants in common account, either party may enter orders, but in both the joint tenants with right of survivorship and in the tenants in common account, all disbursements made from the account must be made payable to all account holders. So we've got individual accounts, we have joint accounts. We can also open up an account for a minor. So these are called UGMA accounts or UTMA accounts. So Uniform Gift to Minors Act or Uniform Transfer to Minors Act depends upon the state in which you live in. Some states are UGMA states and some states are UTMA states. So there's this concept that a minor is not a person. What? I got 4 of those. But they can't own securities directly themselves. So, for example, my oldest boy, he has some shares of, well, once upon a time, Pixar. Now he has a few shares of Disney. So this is the kind of mom I am. I give these kinds of presents. So his shares, he can't own them directly. They're in a UGMA account. So this act permits a parent or guardian to give cash or securities to a minor child. The minor social security number appears on the account. So 1 minor per account. 1 minor per account. It is the minor's social security number that is on the account. So in my story, that's Miles. Miles's social security number is on the account. The IRS is concerned that wealthy clients might use these accounts put their securities investments in these accounts to have the unearned income taxed at the child's rate, which usually is significantly less than that of the parents. So there is what's called the kiddie tax rule. So the kiddie tax rule is discussed in full detail within the contribution limits and current tax law video, because that does tend to change over time. But the basic gist of it is there's always some unearned income that is tax-free, and then there's some unearned income that is taxed at the child's rate. And then over the threshold amount, the unearned income is taxed at the parent's marginal tax rate. We call that the last dollar tax. This rule, the kiddie tax rule, applies when the child is a kiddie by definition, under age 19 or under 24 if they're a full-time student. So UGMA, UTMA accounts are going to be subject to the kiddie tax rule potentially, very commonly. You must follow very specific rules when you open up a UGMA or UTMA account. So one child per account, one custodian per account. It is possible to name a successor beneficiary as well. So one minor per account, one custodian. Now notice, the custodian does not have to be the parent. It's very often the parent. But let's say it could be Miles's grandpa. He could be the custodian. That doesn't change the kiddie tax rule, where unearned income in excess of the threshold amount is taxed at the parent's marginal tax rate. So regardless of who the custodian is, it's still taxed at the parent's tax rate. The securities are registered in the name of the custodian. For example, Susie Rhodes as custodian for Miles Rhodes. That's how his account is titled. Legal ownership is vested in the minor. The gift is irrevocable. So this is a gift, it's Miles's. The custodian retains all management obligations. The custodian may use the assets in the gift only for the benefit of the child. The custodian, who is the donor as well, may not charge a custodial fee. Another way of saying that is if the custodian is not also the donor, they may charge a reasonable custodian fee. So that's a concept you should know for the test. The custodian should turn over the assets when the minor reaches age of majority, which generally varies by state. Commonly 18 in UGMA states, 21 in UTMA states. Varies by state though. And that doesn't mean that the property must become the child's at that age. It can always be set up that it doesn't become the child's property until they're 25 and out of college, or however you would like to set it up. But just generally speaking, it is an asset for the child and it becomes theirs when they reach the age of majority. Securities in the account cannot be pledged. They cannot be pledged as collateral for a loan. We already know the child's social security number is used. There is no limit as to how much you can gift into a UGMA or UTMA account. So if I wanted to put $500,000 into Miles's account, if I had that, I could. However, that doesn't mean that that gift wouldn't be subject to the gift tax rules. So the gift tax rules are also discussed in the current year's contribution limit and current tax law video. So any gift that you make to a minor in excess of that current year's gift tax exclusion is still going to be subject to gift tax. So a tax paid by the person giving the gift. The amount that's over the current year's exemption amount is what is taxable. So we've got individual accounts, joint accounts, we've got accounts for minors. I was reading a study recently about how is it that investors first get exposed to the mutual fund industry? What's their first opportunity to buy mutual funds? And more than 50% of the people first bought their mutual funds within their retirement plans. So an investor can own mutual fund shares through their employer-sponsored retirement plan. Very common. We can purchase mutual fund shares in an IRA account as well. So tax-deferred accounts versus taxable accounts. You can have a trust account, so a fiduciary relationship in which one party, known as the trustor or the grantor, gives another party, the trustee, the right to hold title to mutual fund shares for the benefit of a third party. So the grantor establishes the trust. The trustee manages the trust assets. The trust is set up to benefit the beneficiaries. There are two types of trusts. A living trust, sometimes called an intro vivos trust, is in effect during the trustor's lifetime. And then there are testamentary trusts. These are created through a deceased person's will. And there's other types of trusts as well. Trusts are used for estate tax planning purposes or can be used when a beneficiary is underage or mentally impaired. We talk a little bit about needs for trusts or not within the current year's contribution and tax law video. Mutual fund accounts can have this designation called a TOD, transfer on death account. TOD, you sometimes see the term POD, payable on death account. That would be fine as well. So, for example, my father has his assets titled this way. So whether or not it's his brokerage account that owns stocks and bonds or owns mutual fund shares or his retirement accounts or his checking account and his savings accounts at the bank, he has this TOD designation. And he loves to show me this kind of stuff. It's so cute. So he says, look at my statements. So it has his name, and then it says TOD, my name, and my brother's name. So what this does is it's a way of designating an account beneficiary to automatically receive assets at the time of an account holder's death, without the asset having to go through the probate process. So my girlfriend's mom had passed away recently, and she was named executor of her estate. None of her mother's assets were titled TOD or POD, so my girlfriend Terry had the hardest time getting at any of that money to pay for the very immediate expenses associated with her mom's funeral. She's got 5 kids. She didn't have any money to pay for her mom's funeral herself. So she said, I really wish my mom had done a TOD designation on one of her accounts. So it's very beneficial for your beneficiaries to be able to access your assets upon your death. If mutual fund shares are registered this way, the executor of the account holder's estate will not have to take any action to ensure that the shares owned will transfer to the beneficiary's name. The beneficiary named has no control over the shares as long as the account holder is still alive. So I can't access any of my dad's assets at this point, but upon his death, all you have to do when you are that beneficiary is show a death certificate and you do have access. It's important to know, generally speaking, that a TOD or POD designation has priority over the distribution requirements of the decedent's will. So it overrides the will. This is a way, it's kind of like having a beneficiary on your life insurance policy. It's a way to make sure that your assets go to a beneficiary outside of whatever your will says. So it will override the will. So different types of accounts for sure on this section of your test. Not so bad. Books and records. FINRA Rule 4511 has general requirements for the books and records that all member firms must keep. So books and records must be maintained, of course. Books and records. There's going to be a lot of dates in here, sorry. There just is. It's how it goes. Books and records. So must be maintained for certain periods of time, depending upon the record, under FINRA rules. And under the Securities Exchange Act of 1934. So it is this act, the Securities Exchange Act of 34, that also has books and record keeping requirement rules. So that's very commonly a test question. So it's almost the opposite of what you think it might be. So remember this, the Securities Act of 1933, the very first date you ever need to know, regulates new issues the very first time a stock is sold. So it requires registration, requires the prospectus, full and fair disclosure. Paper Act. Securities Exchange Act of 34, the People Act, defines who a broker-dealer is, defines a transfer agent, defines an associated person, and talks about what the broker-dealer must do as far as books and records. So the Securities Exchange, it's the people that do the exchanging, it's the broker-dealers that do the exchanging. So what do they have to keep and for how long do they have to keep it? FINRA recently passed a rule that says this: if there is a type of book or record that FINRA doesn't have an explicit rule for, so if there's not an explicit rule to keep it for 3 years or for 2 years or for whatever, 4 years, customer complaint records under FINRA rules must be kept for 4 years. The default is, when there's not an explicit rule, that the FINRA rule is at least 6 years. So when there is no specified period under FINRA rules or under the Securities Exchange Act of 34, the default is keep whatever it is. If you have a question of how long, always keep it for 6 years. So it's the default retention period. If books and records pertain to an account, the retention period is for 6 years after the date the account is closed. So we said default when there's not a rule is 6 years. 6 years. Books and records related to accounts. Related to accounts. 6 years from when the account was closed. So you're going to have to practice with some of these dates. You're going to see here that there's going to be a lot of them. If the account isn't closed, then you keep the books and records related to the account from 6 years from when the record is made. So if it's a confirmation, the account's open for 20 years, the first confirmation that was sent is kept for 6 years from when it was sent. All books and records required to be made pursuant to FINRA rules shall be preserved in a format and media that complies with the Securities Exchange Act Rule 17A-4. So it's this idea that broker-dealers are allowed to keep books and records in whatever format they would like. So we don't have to keep books and records in a paper format anymore. It can be computer disk, microfiche, microfilm. Who does that anymore? It could be paper, but it doesn't have to be. There is, though, this rule that says if their books and records are kept on electronic storage media, which is most common today, the electronic storage media must preserve the record exclusively in a non-rewritable and non-erasable format for the time period required under the rule. Records must be made available promptly upon request. So electronic records do not have to be backed up with paper copies, but the firm does have to be ready to provide whatever FINRA or the SEC asks for promptly. So they might ask for paper copies of the electronic records. It's possible. So the firms must be able to provide those records promptly. FINRA Rule 4512, customer account information. So the information that FINRA rules require that you keep relating to customer accounts. For each account, you must know the customer's name, their residence, Whether the customer is of legal age. You can't be considered a person unless you're of legal age. Names of the associated persons, if any, responsible for the account. And if multiple individuals are assigned responsibility for the account, a record indicating the scope of their responsibilities with respect to the account. Signature of the partner, officer, or manager denoting that the account has been accepted in accordance with the member's policies and procedures for acceptance of accounts. And if the customer is a corporation, partnership, or other legal entity, the names of any persons authorized to transact business on behalf of the entity. So this is important. Within FINRA rules for the account, there's different rules. So there's the suitability rule that talks about the client's investment profile and what does that include. This is a rule as far as the books and records that you must keep related to the customer's account. So that there are different lists depending upon what the question is asking about. So here, yes, the customer's name, where they live, what's their age, are they of legal age. Notice that we look for within the books and records of the firm, the signature of the principal who accepted the account, but the name of the registered rep associated with the account. Not their signature, just their name. I don't know what your signature looks like, but mine's really hard to read. So it's just the person's name, and that's a relatively new rule change, so be careful there. For each account that is not an institutional account, each member shall also make reasonable efforts to obtain, prior to the settlement of the initial transaction in the account, the following information to the extent it is applicable to the account: the customer's tax ID number or social security number, occupation of the customer and name and address of employer, whether the customer is an associated person of another member. So you need this information for the individual accounts, the joint accounts. You do not need this information if it's an institutional account. It also says you do not need this information if the account limits its investments to only open-end investment company shares that are not recommended by the member or its associated person. So if that's the case, then you don't need customer's tax ID number, occupation, name and address, whether or not they're an associated person of another member. So be careful there. Interesting, getting someone's tax ID required under FINRA rules, generally speaking, yes, so be careful there. So who is an institutional account where we don't need their tax ID, their occupation, name or address? Are they an associated person? For the purposes of customer account records, FINRA Rule 4512, institutional account is a bank, savings and loan association, insurance company, or registered investment company. It also includes an investment advisor, registered with the state or SEC. It includes any other person, whether a natural person, corporation, partnership, trust, or otherwise, with total assets of at least $50 million. FINRA Rule 4512 requires members shall preserve a record of any customer account information that subsequently is updated. For how long? 6 years. 6 years after the date that such information is updated. So you knew that. A member shall preserve a record of the last update to any customer account information or the original account information if there are no updates to the account information for at least 6 years after the date the account is closed. For the purposes of this customer account books and records rule 4512, the term maintain is used to reflect customer account information that is current or in use. Preserve, the term preserve, is used to reflect customer account information that is no longer current or in use. So this 6 years customer account information, that makes sense The only time that's ever longer is going to be to keep records forever, and that's things like corporate charters. So 6 years is the longest time, short of forever, that we ever talk about. This rule requires firms to maintain the name of the associated person, if any, responsible for the account, not their signature. I said that already. We do get the signature of the principal, however. So that is new as far as it's a change from the way the old rule was. With respect to a discretionary account maintained by a member firm, FINRA Rule 4512 requires firms to obtain the manual dated signature of each named natural person authorized to exercise discretion in the account. Firms can choose to maintain and preserve the signature record on electronic storage media, consistent with the Securities Exchange Act rules. This rule does not require firms to record the date discretion was granted or to record the age or approximate age of the customer in connection with exempt securities. So historically, the rule said you need to know the date discretion was granted. That is not true anymore. So there's no requirement to record that date. We don't need to know the age of the customer that's buying exempt securities. Let's say they're buying muni bonds. Municipal bonds are a type of an exempt security. You don't have to ask the client's name. In the old days, you did, but you don't have to anymore. FINRA Rule 4512 also clarifies that the requirement of this rule does not apply to investment discretion granted by a customer as to the price at which or the time to execute an order given by the customer for the purchase or sale of a definite dollar amount or quantity of a specified security. So when they talk about discretionary authority and needing to have the manual dated signature of each named person authorized to exercise discretion in the account, you don't need that when the client tells you type and quantity. You are always automatically given discretion over timing and price. Nothing in this rule shall be construed as allowing member firms to maintain discretionary accounts or exercise discretion in such accounts except to the extent permitted under the federal securities laws.